Welcome to the About podcast. Here we explore your financial health in simple and easy to understand ways.
All right, well, welcome everybody back to the About podcast, where we talk all about financial health. My name is Jeremy Scott. I'm one of your hosts here, and excited as always to be joined by my good friend and colleague, Roy. Roy Hookie, how you doing?
Hookie like cookie, I am doing well.
Fantastic.
My friend. Busy season, busy life.
Yes.
Things are good, though.
Yes.
Very nice weather.
Yeah, Colorado weather has been oddly good. Mm-hmm. You know, if I was a farmer, I'd be worried, but I'm not. So, you know.
Yeah.
You know, here's what I've learned. Living in agricultural communities most of my life, there's no pleasing farmers and ranchers when it comes to the weather. No matter what is going on, there's a reason they don't like it.
It's always tough.
It is always tough. But we're here not to talk about the weather, actually, but we're here to talk about emergencies.
That's
Roy.
right.
More specifically, emergency funds.
That's right.
Because one thing you and I both know from our lines of professional work is that things happen in life.
They do. We call it the what ifs.
Yes.
Right?
Yes.
What if you lose your job? What if you lose your health? What if you lose your life?
Right.
And the emergency fund part of that is the what if you lose your job?
Yes.
Your livelihood.
Yes. So this is part of our kind of like basic financial education occasional series that we do around here, where we cover a basic financial topic. And as we were talking before recording started, one of the first things that people are encouraged to do when they start thinking about their financial health in life is to think about the emergency fund.
That's right. You know, think of your life as a pyramid or a triangle, if you will. Mm-hmm. Your financial life, I should be clear.
Yeah.
And the base, right, is the foundation. Mm-hmm. Are we building a home on sand, or are we building it on bedrock?
Right.
And the emergency fund is truly the bedrock of your financial plan.
Right.
And there's always people that come in and they ask me about investing. And the first thing I'll ask them is, how is your emergency fund?
Okay.
And then we, dig into a lot of other stuff too, because it's not just simple as saying that. They can tell me what their number is, but I don't even know if that number is accurate.
Right.
So the basics of starting with an emergency fund, I'll walk you through that.
Yes.
But first question for you, Jeremy.
Yes.
What do you know about emergency funds?
I know they're good to have.
I love those technical answers.
Yes. So I don't honestly know a lot. I do have, as you know, as my personal financial
I'm pretty
advisor.
sure I required you to.
Yes,
you did a good job.
We did have a conversation about this, and I do have some money set aside that I think of as my emergency fund, or I think when we were talking about it, I called it my so I can sleep at night money. Right, like it's just that little bit that's sitting out there, more than a little bit, I suppose. That is just like, all right, worst comes to worst, sky falls. I'm not completely without recourse.
Yep.
Right, and I think for so many people, they look at things like their credit cards as the thing that's going to fill that gap if something awful and terrible happens, but you and I know, and most people who have dealt with credit cards in a strong way knows that that's not the best solution.
I believe I recall you talking about getting a T-shirt previously.
Yes.
On a different episode of you getting some credit card advantage, right?
Yes.
That T-shirt cost you probably way more than a normal T-shirt.
So much more.
It was a learning experience.
It was a learning experience. It was a very expensive learning experience
Yes.
about the dangers of credit card and credit card debt and high interest. So,
But yes, you're accurate in the representation that people will use their credit card as a fallback.
yes.
The problem with that is it is a fallback in that situation, but then how do you pay off the fallback?
Right.
You used it, life happened, like it will for everybody, and now how am I going to pay that off? And that's actually where people probably get caught the most. They're like, well, we had to do this, and we just haven't been able to pay it off.
Right.
So there has to be sacrifice. At a certain point, they get to someone like me, and they're like, well, what are you willing to do what are you willing to sacrifice to actually pay that off? Because what you're doing now isn't working, and you're paying 18% on that.
Right.
right? That doesn't make any sense at all.
Yeah. It honestly extends the emergency, right? It gives the emergency a really long tail versus if you have a fund and you're taking from it, then you probably want to repay yourself back. Obviously you want to rebuild that emergency fund if you end up using it, but that's different than, and that's going to be, you're able to accomplish that a lot faster than 18% compounded interest on, whatever it is. Like the tail is just so much bigger.
I'm going to do some math for impact here.
Oh yeah. Do some math.
Okay. So the rule of 72 is a real thing. And it's
what's the rule of 72, Ron?
Thank you for asking. It's used to calculate how long it will take your money to double. Now I'm going to flip this on its head and say, how long is it going to take for the credit card company to earn double on you?
Oh.
Let's do some math. So let's say we had an emergency, it was $5,000. Okay. And let's say that $5,000 cost you 10%. I'm using 10% because it's easy math to start with, right? Well, if
you can get a credit card at 10%, good for you.
I know, right? But 10%, we divide that into 72, which is 7.2. Okay. So if you pay on that credit card and you don't pay it off within basically 7.2 years, or if you just paid the minimum required for that period of time, it will, at the 7.2 year mark, that $5,000 just cost you $10,000.
Oh, okay.
So the credit card company just doubled their money on you. Okay. So now, like you said, 10%, not realistic. Realistically, more like 20%.
Yeah.
So now your 7.2 just went down to what? 3.6 years. So if you got a credit card at 20%, 20 divided into 72 is 3.6. Follow my math on this? You're looking at me sideways.
No, I got you. I got you. I do have a degree in computer science where I can do math in my head.
Well, I'm just making sure.
I got you. I'm with you. No, okay. I got you.
So now the credit card's at 20%. If you're paying the minimum required, then in 3.6 years, you just paid $10,000 for that $5,000 emergency.
Right.
Okay. And I've seen credit cards at 28%, 32%.
Oh, yeah. They're crazy.
So that is why this is such an important conversation. And this is also why people get stuck. Well, I thought I would be able to pay that off, but they didn't calculate in the fact that they have to pay interest to get access to that money.
Right.
And then that's actually what perpetually keeps it going.
Yeah.
So that's why this is so important. That's why we're having this conversation.
Right. And the idea being, if you're borrowing, if you have an emergency fund, you're essentially going to borrow from yourself. So that payback period is much less, unless you're going to charge yourself interest, which I suppose you could do.
And even if you do, it's interest in your pocket.
Right.
Right. So you could say, I want to disincentivize myself from borrowing from myself, unless it's truly an emergency, and I'm charging myself interest to kind of like have a repercussion, right? That you have to pay a little extra back into your emergency reserve.
Right. Well, and at the end of that, either 3.5 years or 7 years, whatever it ends up being, I'd rather have $10,000 in my pocket in my account than having enriched the credit card company to an additional $5,000.
Exactly.
Yeah.
And you're a pastor.
Yeah.
You have a church to oversee.
I do.
Not only do you have your personal residence to oversee, and your church has an emergency reserve.
Yes, we do.
And we've actually borrowed from our own emergency reserves versus borrowing money. Now, we couldn't do that before.
Yeah.
So it's not just for the personal level; it's for just money in general.
Well, because I'm blessed in that I get a regular paycheck for what I do, but there are seasonal employees who don't, and so you got to smooth out those things, or teachers, depending on how they choose to get paid, or things like that, or maybe some seasonality to the employment. You make more at a certain time of year. So you're going to want to save some of that to smooth out.
A lot of business owners have, bunching on when they make money.
Yeah.
Right. So a great example is a CPA, right? Some of them have payroll and they do stuff all year long and you get some money for that.
Yeah.
But largely their revenue comes during the tax season when they actually do the tax preparation.
Right.
So they have to, huge amount of money coming in a few months, and then the rest of the year, not a lot. So they have to manage that. And it could be similarly for a person's household, depending on the types of jobs or commissions or things like that, right? Yeah. So this is why the emergency fund, even if you think the money's just being wasted, just kind of hanging out, It's not. Right. It's not just hanging out. It's there for the rainy day and the what if that comes along.
So credit card's not a valid emergency fund plan if you can avoid it.
Not if you can't pay it off.
Not if you can't pay it off. And if the emergency is you've lost your job, then the challenge is like not only have you lost your job and your ability to meet your bills, it means that at least for a time you don't have the ability to pay back any loans or any credit card debt that you may take out.
Yeah, that's exactly it.
So, versus having an emergency fund, a pile, some cash set aside that is set aside for this purpose obviously makes some sense and is the reason why it's kind of financial planning 101, right? Because you need to be able to smooth over the rough bits of life, which are never going to happen without derailing your whole financial plan. So that's what it's there for. But then the next question is like that I'm sure anybody's asks you when you ask them about this and they look at you like doughy eyed, like I don't know what you're talking about. Explain what an emergency fund is. The next question is like, oh, okay, how much?
Yep, that's actually a great question, and that's why the visual of being at the bedrock of your plan is the biggest piece of that, because people don't realize that everything stops when you don't have that paycheck. But not only that, now think about it like this: let's say you do have those obligations, you don't have an emergency fund. Are you going to get the first worst job, or are you going to get the best job for you?
Right.
And if you have an emergency fund, you have some flexibility and breathing room. Mm-hmm. If you do not, you got to get a job.
Right.
Or you're going to go further in debt and there's problems, right? But I actually have a situation right now where a client spoke to this week, has been out of the job nearly a year, applied for over 800 positions.
Whoa.
800.
Yeah.
So it's even though you think, I'll just get another job. That's not just how it works.
Right.
It just depends. The industry, the sector, your experience, what are people willing to pay? What are you willing to accept?
Yeah.
And that all plays into it. So you can't ever think best case. You have to think worst case. So I'm telling people this specifically because I just want them to know that this is really important. Right. To not think best case. You always think worst case for your emergency reserves.
Right. Well, and how do you maintain some level of freedom in that worst case scenario? So if the worst case scenario is you lose your job and say you've got, especially if you have something that you're a little bit more specialty in what you do, right? And so maybe the jobs aren't as thick on the ground. So you do need to be able to buy yourself some time, right? And so you want to have the freedom to take the time. Maybe we should, instead of calling emergency funds, we call them freedom funds.
Well, it is interesting that, not only is it the freedom, but it's the dignity. And we've talked a lot about that before on this podcast, where we're trying to help people age with dignity. And if you get into a pickle, mm-hmm. which we've all known somebody who has, even if it was ourselves.
Right.
And to have the dignity to not have to go get help. Right. In that situation, right? Now, really bad things happen, and sometimes help is needed, and that's why we have, a lot of other things for that stuff. But when you can prevent it from being something that bad, it gives you the ability to age with dignity and make good decisions for you and your family, find jobs that are the best for you, and not have to sacrifice on those things because you weren't as prepared as you could have been.
Right.
Now, the question everybody has to answer is, what are you willing to sacrifice to have that?
Right.
And we live in a world that it's a lot of times people aren't willing to sacrifice or wait for the reward. They want the reward now. Mm-hmm. So should I spend the money on this vacation even though I don't have an emergency fund? Now, you can't not live life, but maybe you got to balance the two. Okay, we want to have some fun money, but we also need to have some serious emergency money.
Right.
So we can't maybe do both at the same time. So maybe we can do a little bit of both. Yeah. We do a smaller vacation so we could still partially fund our emergency reserves. Does that make sense?
It does, absolutely, because it's all trade-off, right? I mean, there's a point at which, in my life, I often, talk about the idea that life isn't a zero-sum game, right? That, just because we talked about this on this previous Sunday, right? Love is not pie, right? So I can give away some love. It doesn't mean I have less love, right? But money and your income kind of is, right? I mean, unless you're going to get another job or something else.
Finite.
It's a finite. There's a finite amount that comes in and you got to figure out where it's going to go. So you are going to talk about some trade-offs. So is there a rule of thumb that people should have in mind, though, when they think about, say, I don't have any kind of emergency fund, or I've got, $5,000 sitting in a savings account, or whatever. How do I start to begin to estimate how much I should have? Because there's a point at which maybe, I don't know if it's possible for there to be too much, in your emergency fund. But, how do I figure out what the floor is? Is there a standard?
Those are really good questions, and I do have an answer for you. And I'm a certified financial planner, and the certified financial planning program does have, obviously this is a big part of it.
Yeah.
But let's just talk about it from common sense, right? So let's just say that you are a single person, right? You're working your job, you have your bills, right? But you're working a job where you can pay your bills and have a little bit left over. What do you think, just commonsensically, what should we put aside if I have one income, I have a little bit of excess reserves every month? What should I do? Like, what should I do in regards to how much I should put aside? I mean, just commonsensically, what would you think?
Well, I mean, I think I'd look at, what my required spending every month is, so that's like rent and car payments and kind of things that I have to pay.
Okay.
Not maybe, because if I lose my job or something like that happens, I'm probably not going to go to the movies, right? Anything discretionary, I can probably, find a way to whittle that down.
I like your language.
But there's non-discretionary, because I can't just immediately get out from underneath my mortgage, or I can't immediately get out from underneath my car payment, or whatever.
Your rent, or whatever it is,
or your rent, or your, whatever. So I would probably start by looking at like, okay, per month, what's that number as a starting place to say, okay, like these are the obligations I have to meet every month.
That's a great starting point. And really, when I use the language I use necessary and discretionary.
Okay.
I actually use that language. So necessary, I have to pay my mortgage or my rent. I have to pay my car insurance. I have to pay my cell phone bill, right?
Right.
Those are things you're gonna pay. Well, you don't necessarily have to have cable.
Right.
If you're in a pinch, you can probably let that go if you had to.
All right, it's 2025 or /26, right? Netflix. You don't have to have Netflix.
Right? Yeah, with Netflix trying to buy everybody right now.
Yeah, I was gonna say
Netflix
Netflix is going to own everybody at this point.
But so those are the necessary versus the discretionary. The non-necessary is the word you used.
Okay.
And that's a really important starting point. So let's just use that as the basis. So what do I have to pay just to keep my life functioning that's required spending?
Right.
Then you can say to yourself, okay, do I want to save enough to make it also cover my non-required spending?
Okay.
Because you could.
Yeah.
You don't have to. But if things are tight, maybe you say, no, I'm not going to in this situation right now. But if you have a little bit excess reserve and you're like, well, I could cover that, then maybe you do.
Yeah.
That's a decision point for you. But at a minimum, we're going to look at your necessary spending.
Okay.
Okay, so you're single. All right. How long do you think that a single person should have, coverage for those monthly bills?
Okay. So with my assumption being that, chances are what the dominant emergency people tend to get into, my guess is unemployment. Unexpected or maybe expected, you get downsized.
Well, let's say worst case, no unemployment.
No, but I mean, that's the emergencies. I don't have any income.
Got it.
Right, for whatever reason. But I'm unemployed. Not unemployment insurance.
Yeah.
I'm unemployed, either because of medical reasons
Don't have a
or
job.
whatever. So then the question is like, well, how long do I want to give myself to be unemployed before I can find, the next thing?
Yep.
Right. And if there's no emergency fund, then that's probably going to be counted in weeks. Even if you're lucky. And so that's when you end up in a situation where maybe you're taking a position you otherwise wouldn't want to take.
Home Depot or
just to cover the bills. I probably would want it counted in months, right? Because I'd want to be able to, it takes time to get your resume put together and get applications going out. And, some jobs have seasonality. If you're a school teacher or whatever, there's a time in which most of that hiring is done. And if I happen to find myself unemployed at another time, then I think that's the next question is like, how long? What's the window you want to give yourself? For me, I think that's probably 3 to 6 months.
Okay. So if you're single per the CFP, 6 months.
6 months
is the goal if you're single.
Okay.
If you have joint income and they're not drastically different, what I mean by that is let's say that one of the spouses is making $100,000, the other is making $25,000.
Oh,
that's a great disparity. So we need to have more of a conversation around that because if the one who had $100,000 income lost their job,
It's a bigger deal.
It's a bigger impact to the household than the $25,000 one.
But if you're married and say it's fairly equal.
If you're married and it's fairly equal.
So that's like my situation now. Me and my wife, we make pretty decent. We make very equivalent money.
Yep. Then you would want at least 3 months.
At least 3 months. Okay.
Now, the situation where a married couple wouldn't be able to accept just 3 months is if they work for the same company.
Okay.
So let's say that you and your wife worked for the same corporation, even though you had different jobs, but your exposure is to that one company. And if they did a big layoff or something like that, you could both be hit.
They get purchased.
Right.
Yeah, okay.
So then you would have a 6 month.
Okay. And when you say 3 months, you mean 3 months of the total amount.
Of necessary spending.
Total necessary spending.
Yep.
So with the idea being that that's really 6 months of half my normal income.
Well,
because that's effectively what you're working. Because assuming is like the hope is that both my wife and I are not going to end up unemployed at the same time.
That's right.
Yeah,
that's right.
Now, worst case would say, maybe what if you do?
Yep. So it's a good way that you just have the ability to find the best job for you, not the first job for you. Right. And not have to rush into a bad situation. Yeah. But that's a great rule of thumb.
Okay.
Now, the other thing you can think about is do we put enough in that reserve that covers the unnecessary as well? And that's just a decision point. For instance, let's say your necessary is $2,000, but everything together is $3,000.
Right.
Well, if I need 6 months, right, that's $18,000 if I'm covering everything, and I don't have to change my lifestyle while I'm looking for a job.
Right.
I still want to go to the movies or go out to eat or whatever.
Right.
Or you could only need $12,000.
Right.
If you just covered the necessary costs. Does that make sense?
Yeah.
So when people are looking at this and evaluating, and if you're not sure of your situation, just err to the more cautious side of hitting the necessary stuff at the minimum.
Okay.
And I get this all the time, by the way. It doesn't have to eat the whole elephant in one bite, right? Like we need to you don't have one, let's get 1 month.
Right.
Then let's get 2. Right. And depending on your situation, push to that 3 or that 6, depending on what's going on for you. But just start somewhere.
Right.
And you don't have to sacrifice your life to do it. Balance is always key. You have different buckets of money. Right. Fun money, you have serious money, right? We have the expenses money, we got to pay those bills money. When you're looking at your monthly income, how am I allocating that?
Right.
So, but sometimes when people get themselves in bad situations, they have to start making sacrifices and say, hey, I can't do what I wanted to do and I have to cancel that vacation or whatever it is. Like I'm getting, a coffee at the coffee shop once a week or two or whatever.
Well, I think the goal is to say, obviously if something happens that triggers an emergency that would use the emergency fund, then clearly something went wrong or unexpected happened. And the idea is to kind of cushion that blow and say, of course, even if you knew for sure, you're probably still going to make some kind of sacrifices anyway. You're going to get much more conservative in your discretionary spending, while you're unemployed, no matter what. But the question is like, how much do you want to cushion, that blow and give yourself, again, the time and the freedom to move through that space and have as many options open to you as possible. Yep. So I think I'm going to start calling. We call them freedom funds, like have some freedom in there. And because the challenge is, especially if it's unemployment, it's a lot easier. You have a lot more time and energy to dedicate to finding a job, while you're not working. But if you've got to take the low skill, whatever job just to pay the bills, that's less time than you have.
Yep.
To do what you need to do.
So I had someone come to me recently and they wanted to invest.
Yeah.
And I asked them about their emergency situation. I probed into their expenses and all that stuff and got a little bit more clear picture. And I said, hey, I'd love to help you, but you need to get to the point where your foundation is on bedrock and not on smoke and mirrors. Right. And I've had that situation before where people are like, I really want to invest this money. I'm not going to touch it. I promise. And then they call me 6 months later and they're like, I need to pull some money out. They paid fees. There could be tax consequences. They could have market loss. So if they don't have that emergency fund first, then I just tell people, no, you can't invest until you have that.
So the emergency fund. So I've got my number. So say, and I'm actually doing a little math in my head. I'm like, okay. And I've got my number. I figure I wanted, 3 months. It's X thousands of dollars. What am I doing with that? Is that in a coffee can underneath my mattress? Am I buying gold bars? Like what am I doing with my emergency? Is it sitting savings account at the bank making 0.001% interest. Like what am I doing with that money?
You typically want to keep it in a liquid format,
Yeah.
right? Liquid and available. And depending on what rates are doing, for instance, if you have a savings account now and you're not getting much return on it, you really should consider a money market.
Right.
But it depends on the bank that you use. They just have rules around their money markets that, can you access it multiple times a month, or is it got restrictions, or can you only pull so much out? So you have to be careful with that kind of stuff, right? So clients that work with me, I largely hold their emergency reserves because I actually put them into a money market that's on the secondary market, right? So there's money markets that exist out there in the investment world for short-term money, whereas banks create their own internal money market typically.
Okay.
So that's why they have rules on it, because if they're lending the dollars out to make money for the bank, they can't have you come and just easily get all of it all at once, right? So they put some restrictions on, that's why. But the ones I'm using are just secondary investments on the market that we can go get, and they're more liquid.
Right.
So people that work with someone like me can talk to your financial advisor about, should I put some money with them to just keep it in a money market, or layered CDs. For instance, we talked about 3 and 6 months. So let's say it's a 6-month, nugget that we're looking at.
Right.
Well, maybe we buy a 3-month and a 6-month CD or something like that.
Right.
Maybe have some in money market, some in CDs, 3, some in 6, and then things just kind of keep rolling. You're just trying to get a little bit better return on your CD, right?
Right.
But money markets right now are so close to CDs that I don't do that right now.
Yeah.
It just depends on the interest rate environment that we're in. Yeah. But you should definitely, today money markets are in the 3% range. So you should be at least getting that on your short-term money.
Right. Okay.
You shouldn't be getting 0.03.
And I feel like there's probably some value in there being, a little bit of friction in getting the money out. So it's not just that, but not a lot. So like for me, like mine is with you, and so I can have it whenever I want it, but I got to email you, or I got to go online, I got to do a thing. There's some hoops I have to jump through, and I can have it the next day if I need it. But even just that little bit of friction just kind of keeps it out of mind.
Yeah.
Versus sitting it like maybe sitting it like in a savings account in my bank where I'm looking at it every time I pull up my online banking.
Like, I could really buy that TV if I had that money.
Yeah. So there's a little out of sight, out of mind.
Yeah,
so there's a psychology to this whole thing.
It just creates a gate.
Yeah.
And all you have to do is, go to the gatekeeper and request it, and you're going to get it. But
it's your money.
But I'll be like, what are you doing with that? I'm like, do you think you should be doing that with that?
Yeah.
I don't tell people how to spend their money, but I do ask and try and help guide them to make good decisions.
Well, I mean, we talk about this all the time. The value of having a financial planner is they can remind you of your own goals.
Yep.
Right. Your goal is to help me reach my goals, and all your clients reach their goals. So if I say one of my goals is to have a robust enough, emergency fund so that I can, sleep at night and not worry so much. And if I come looking for it, you're going to remind me of that goal. And then I'm going to say, I don't, give it to me anyway. And you're going to go, okay.
Yep. And then for future podcasts, it comes down to, what do I do if I have if I have a pool of money right now, and people are doing the mental math, right? I've got more than 6 months. So do they need that? And the question is maybe, it's a personal decision. I think you go past the 6-month number and it's kind of getting a bit, high if you have a joint income and you both have good incomes and things like that. But it's a personal decision. So I have one client that they want 12 months. They're in a little bit riskier profession. Okay. So that's why they wanted that. But then once you get to your target on how much you want to have, then you can start deciding, how am I now allocating the excess dollars past that target?
Right.
So if you have too much right now sitting in your emergency reserves, then it's like, okay, where am I putting that for my future? Is it going to go into my fund bucket? Is it going to go into my home renovation bucket? Is it going to go into buy a new car bucket? Is it going to go into, I want to go to Disney World? Am I going to put it into my investments for my retirement to maybe be able to retire earlier, or just have more available to us so that there's less risk? And those are all the fun conversation pieces that then are like, well, what's most important to you? Why do you want those things? What do we need to do to get those things, and how do we actually make that happen?
Yeah. I like it. All right. Yeah. So the emergency fund, financial bedrock to everything else.
Financial bedrock. That is actually the greatest way to view it in your head. If you don't have it, you're living on quicksand.
Right. Because the world is uncertain, and it seems to be that doesn't seem to be changing.
Life will hit you in the eyes, in the middle of right between the eyes. and we all have to deal with it at some point.
Right.
And we can prepare. We can't know everything. Like if you have an illness or something like that, a 6-month emergency fund may not be enough, but you can't prepare for a 10-year emergency fund. I have a client that has that kind of going on where they can't work like they used to be able to. And that's now a disability kind of situation, but you can't solve everything. We could just do the best that we can.
Right. Well, that's when the other mechanisms kick in, right? So maybe you do need to look at disability. Maybe you've got an accident, an AD&D policy, or one of Social Security, or one of those other mechanisms. But those processes also all take time.
Yep.
So part of the emergency fund is that gap, right? Yep. To fill that gap between maybe I don't want to go back to my former profession to make what I need to do. So maybe I need to downsize my home. That takes time.
Yep.
And you don't want to do it. You don't want to be forced to do it, but you're like, okay, I'm going to make a pretty decent change in my lifestyle. I need a gap.
Yep.
To fill that gap while I do that.
And that's why I use the what ifs, because I just think that's a great way to do it. What if I lose my job? What if I lose my health? What if I lose my life? We deal with the job first, emergency reserves.
Yep.
Then we start talking about what if I lose my health?
Right.
There's many ways that can occur, but then we can talk through it, at least educate what's the plan.
Right.
And then what if I lose my life, and how am I going to leave things and structure things for my loved ones if something happens to me in that situation?
Those sound like great topics for future podcasts, Roy.
I think we could probably do that.
I think we probably could. So I love these kind of 101 kind of, basic financial tools and planning things. I think that people maybe hadn't thought about this too much and said, oh, okay, like that feels manageable. That feels doable.
Yep.
Right. The 3 to 6 months, like, okay. And it may take you a year or two or however long to get to the point where you've got that, but no better time to start than the present.
Exactly. And you don't have to eat the elephant whole. Just start somewhere.
Right. Love it. Love it.
Awesome.
All right. Well, thank you all for coming and participating and listening or viewing or however you're consuming this. If you have kind of a basic financial question that chances are you're not the only one who has that question. So please maybe let us know. Leave a comment or email or get a hold of Roy here at Credentialed Wealth Advisors of Johnstown, Colorado.
That's right.
And let us know what those questions are, and we can add that to the queue for a future podcast.
I look forward to it.
All right. Thank you, Roy.
Thank you, sir.
CWA is a Securities and Exchange Registered Investment Advisor. No content contained herein should be construed as an offer for investment advice or an offer for the purchase or sale of any security, insurance, or other investment product. Investments involve the risk of low loss, including loss of principal. Please consult with a qualified financial, tax, or legal professional before implementing any strategy presented here. Data presented here are obtained from believed reliable sources but cannot be guaranteed as to completeness or accuracy.